Good evening, this is John Milburn for PROP13001. This week we're dealing with week 4, which relates to development finance. During this unit, you'll find some of the weekly unit topics more difficult than others. I think this is one of the more difficult ones, probably weeks 3 and 4 are the most difficult. So what are we trying to achieve in this week's discussion about development finance from the perspective of a property developer? The first thing is that you'll be looking to achieve some understanding of institutional lending practice. And by using the term institutional, I mean not just mainstream banks and financiers, other institutions as well, and we'll discuss some of those this evening. But the first point there is understand their practice, their lending practice. As a property developer seeking development finance, don't make the mistake of walking in cold and uninformed. You need to know the financier's business and be prepared to answer the questions that the financier will want to have answered. The next thing is you'll need to appreciate the importance of preparation. So that follows on from understanding their lending practice. You need to know how to prepare and present your application for finance to financiers when seeking to obtain funding for property development. The other thing is that you need to understand the options that are available to you as a property developer. What type of funding can you seek and how do you categorize that? So during this week, the reading material, you should seek to obtain an understanding of funding through by reference to time. So you'll see funding that is short-term, mezzanine or long-term financing, and you'll see funding that is available to you by type. So there's mainstream funding through a bank, for example, but there are alternative models such as joint venture agreements, and we'll discuss those this evening as well. When you're applying for funding, you need to understand that in a practical sense, what you're doing is working upon the material that you worked in feasibility, where you came up with a profit analysis, and you're trying to match the profit analysis models that you've developed with funding proposals. So the financier will want to know that you are looking to develop a property, perhaps in a prime site, perhaps in circumstances where you seek to develop in a manner where you are selling the finished product or perhaps retaining the finished product. That will be relevant from the outset because it will affect the type of funding that you seek from the developer or from the financier. Financiers will look at you critically. Don't blame them for that. Financiers are in business and you need to understand that this is a business proposal. So although you may well be proactive in your approach to a bank or financier, you need to set out your development proposal very clearly and satisfy the lending criteria. Be aware that financiers will look at your track record. You need to be prepared to sell your track record, not in an inflated manner, in a realistic manner, but in a way that shows that you do know what you're doing. Now, of course, the problem is that when we talk about a track record, it implies that you've done this before. So it begs the question, what does a property developer new to the industry do in order to secure finance for that critical first development deal? Well, I guess the issue is that you need to be well prepared and have a very good proposal in mind so that you can overcome the natural barrier that the financier will have in considering your relative newness, if that's the right term, to the industry. I mean, I guess all of that really comes down to the issue of preparation. You need to be very well prepared before approaching potential financiers for development finance. And as part of that preparation, you need to have a written proposal and you need to understand the financier's concerns. You need to package the proposal in a professional and comprehensive manner. You also need to be realistic. There's little point in making an appointment with a potential financier and proposing a funding model that would expose the bank to unacceptably high gearing levels. Gearing levels mean effectively the ratio of lending to the value of the property concerned. So you need to have some groundwork knowledge and knowledge of what it is that the bank will look to do and what they're prepared to do. So in presenting your application, in asking for finance, you need to be well prepared. You need to package and present your material professionally, comprehensively, and that will probably need to include high quality research. And we'll talk about market research and other tools later in the unit as we progress. But the point, as I mentioned, is lenders are in business. This is a business transaction. So what is it that the lenders will be looking at from their perspective? Always good to step in the shoes, as it were, of the person with whom you're dealing and look at it from their perspective. Well, I guess in simple terms, the lender wants to know that in advancing money, it will be repaid, it will be repaid on time, and all costs, such as interest and other costs, will be repaid as well on time. It's essentially an issue of risk evaluation from the bank's perspective, and they want to ensure that they have a return of the loan and they have a return of expense. So you need to know what the bank will be considering as part of its risk evaluation process. You'll need to know the bank or the financial institution's policy, and you'll need to understand that the financial institution will always be looking at the strength of the security that's being offered. It will need to ensure that its loan to value ratios work within bank policy. So when you're preparing your package for financing, think about your financial strength, think about the property asset, your own track record, or at least your record of accomplishments that have led you to this point. Think about the profit level that you expect to make, and don't be afraid to incorporate that into your cash flow projections, and then have comprehensive cash flow projections to support your loan application. After all, what the bank wants to know is that it can have a feeling of security, that it will lend you the money in the knowledge that you have the ability to complete the project, you can do so on time, at cost, you have a good team of external advisors around you, and you have carried out a proper assessment and a proper evaluation of the process, and you've presented this as a party that can actually make this achieved, or can achieve this task that you seek funding for. Now, it's more difficult now to obtain development finance than it was. 2007, the global financial crisis, saw a dramatic decline in consumer wealth. It saw a dramatic decline in the number of development funding available or applications being approved. Essentially, there was a downturn in equity markets, there was a downturn in property markets, there was the actual or threatened collapse of large financial institutions, there were government bailouts of banks, and all of this led to a downturn in economic activity. And property development is very much aligned to economic activity. When people are doing well and they're prepared to spend money, they might be spending money on your property development as an investment, or as somewhere to live, or as a second home, or a brand new office, or a new business, or whatever it might be. So a downturn in consumer wealth, confidence, collapse of institutions, global economic crisis, or global financial crisis, all means that it's more difficult for property developers to make money. And of course, it makes it more difficult for financiers to provide money. They will be reluctant to provide money for fear of being burnt again. There's another factor, and that factor is that governments will be reluctant to invest in infrastructure that would be necessary to support new developments. So the downturn in the financial markets, property markets, the global financial crisis has created a different regime, a different paradigm, and developers need to work within that. All right, so let's assume that you've decided to apply for funding. let's assume that you've decided to apply to a bank for funding. What do you ask for? Well, you need to understand that there are three types of fundings available through, if you like, mainstream financiers. Short-term funding, long-term funding, or mezzanine or hybrid funding, which sits in the middle. Development finance in the short term means obtaining funding to pay for the initial property development, to pay for the initial development costs. Long-term finance relates to your request to obtain funding to enable you to not only develop the property but then retain the property as an ongoing source of investment income. In other words, the property developer becomes the investor and doesn't necessarily sell the property to an investor, at least not in the short term. Now, mezzanine funding provides the bridge between short-term and long-term finance. Mainstream financiers will be concerned about loan-to-value ratios, and there's a limit on how much you can get. Now, mezzanine financiers will provide you with additional funding at greater risk to them, but at a higher cost to you as the property developer. So that level of funding comes at a cost and should be factored in to the cash flow and other projections by the property developer from the outset. We will talk more about alternatives. Institutional developers might go into a profit share arrangement or a joint venture arrangement with financiers as well. So those institutional investors are looking to obtain something for their portfolio, and this might be a real estate investment trust. In the study guide, I've given you an extract from the ASX website, which explains the Australian Real Estate Investment Trust regime, and it's all about giving investors access to property assets. So as a property developer, you might want to deal with an Australian Real Estate Investment Trust because it's an avenue for your work to be undertaken. It may be that you work on the basis that the trust purchases the completed product or helps to finance the product to completion and then purchases the property. But ultimately, the investment trust is looking for a good quality investment that provides a good, reliable return as part of its portfolio so that it can attract investors to purchase an interest in the investment trust. And those investment trusts will usually look to diversify their property portfolios. They'll consider the strength of the tenants, the tenant type, the ability of the tenants to pay, and the investment yield. So as a property developer, I would think that if you're going to pitch your development for sale to an Australian Real Estate Investment Trust, you want to have some idea of what that trust already has acquired, how your development proposal might fit into their property selection and diversification, and try to tailor your proposal to meet their needs, and rather than just necessarily concentrating on your needs. Now, if you're dealing with a mainstream financier, there are a few basics that you need to consider. The first is to be aware that the financier will invariably ask for first mortgage security over the development land. Financiers dealing with a company, a development company, will almost invariably ask the directors of that property development company to provide a personal guarantee for the performance obligations of the development company. Now, I assume that all of you know what a mortgage is. A mortgage is where the borrower, the property developer, the mortgagor, borrows money and in return grants the lender, which is the mortgagee, interest in property by way of security. If you get confused between mortgagee and mortgagor, the borrower tends to be the poor one in the relationship. So a little rhyme is the mortgagor is always poor. That might work for you. So a mortgage then creates an interest in the property which is being developed, but it's also a contract, and that's often overlooked. It's a contract that incorporates terms and conditions, and that those conditions bind the parties. Now, one of those conditions is that as the mortgagor, that is the property developer, you're not to dispose of the property without the mortgagee's consent. Usually that's pretty straightforward. If you take a mortgage over property and you ultimately sell that property, then you're usually going to pay out the mortgage from the sale proceeds and keep the balance. Pretty straightforward. But in a property development, it's a little more complex than that, because whilst you may start with one property over which the financier takes a mortgage, once the development is completed, there may be a number of titles that relate to that former single property. So if you have a property of whatever, how many hectares, which is developed, and it might be developed into, for example, commercial shops on the ground level and residential units above it, you may end up with, say, 15 different free simple titles on a property which was previously one title. So each unit, each commercial unit, each residential unit within that developed project has its own fee simple title to its own individual property as part of the body corporate. So what happens if the financier has a very substantial amount of money owed to it, and the property developer wants to sell one unit, either commercial or residential, in circumstances where that is insufficient and possibly well insufficient to pay out the entire loan? Well, what happens is this. The property developer will ask the mortgagee, the financier, to provide, if you like, a partial release of the mortgage, which means that there is an acknowledgement by the financier, the mortgagee, that the full amount is not to be paid out at sale of one of the individual units that has been created as a result of the development, but nevertheless the mortgagee will give a full release of the security it holds over that individual developed freehold unit. I hope that makes some sense. Typically, the financier will say, we'll do that, provided we receive all of the funds from the sale of the property. As a property developer, it's critical that you're aware of this practice, because it's not going to work if your cash flow projections incorporated a provision that you would keep the money from the first 4 or 5 sales with the intention of paying the mortgagee later or progressively. It doesn't work that way. The mortgagee will say, I'll have all that money, thank you very much, probably until the mortgage loan is paid in full. So somehow the property developer, in funding the proposal, needs to build in that factor. And what if things go terribly wrong? What if the property developer defaults on the mortgage loan? The mortgagee comes in and sells the mortgage property. Of course, the financier, the mortgagee, will keep whatever proceeds are available through those sales up to the loan amount, including interest and costs. But what if, as a result of selling all of the mortgaged property, there's simply not enough to pay for the entire debt? Well, here's where the fact that the mortgage is both a contract and a security comes into play. As a contract, there is a personal covenant on the mortgagor, the poor one, to pay the debt to the financier, the mortgagee. And if there's a shortfall, the mortgagee may sue on that personal covenant to recover any amount outstanding, even if the financier had discharged the entire security to buyers. So build that into your reckoning, and don't make the mistake as a property developer of thinking that, well, if things go bad, at least my loss will be limited to that particular development. It doesn't work that way. Everything is interconnected, and the personal guarantees and the personal covenant may well have an effect on other assets owned by the development company, or even personal assets such as a family home owned by the property developer. So that's a risk inherent in any funding proposal for development finance. But when you're considering your development finance application, consider other factors such as macroeconomic risks. Be mindful of the cyclical downturn in property markets. Think about the worst case scenarios involved in, say, economic recession or high interest rates or an oversupply of new buildings. All of these things can create substantial difficulties for property developers, and if that happens, it creates uncertainty for financiers. Essentially, I'm inviting you to forecast, but when you do forecast, consider at least as one scenario the worst case scenario and try to build in contingency plans should that worst case scenario eventuate. One thing you need to consider is avoid is overextending your loan and commitments. Because if you overextend and you're running on very tight budgets, you may find that just through timing alone, you're unable to pay subcontractors or your financier or council for rates, and all of those things can have a devastating effect. Not only do you run the risk of being sued or people down tools and stop working, but the entire project could simply collapse. There's negative press involved, and before too long, very quickly, potentially, liquidators are on the doorstep wanting to have a piece of the action. And I mean that kindly to liquidators. So property developers need to build in some degree of padding to cater for contingencies. So I guess really those comments that I've made largely relate to issues to do with obtaining short-term or mezzanine finance. And mezzanine finance is the funding that's available when you've essentially exhausted the funding that's available through mainstream banks. So mezzanine funders typically are smaller, nimble, charge a higher interest rate but accept more higher risk, and they are likely to really want to get in and have a look at the development proposal and make sure that it stacks up, maybe even take on a part of it as some sort of joint venture arrangement. But let's assume that you're not looking for short-term finance now, you're not looking for mezzanine finance, you're looking for long-term finance, because as the property developer, you've decided you want to become the investor. You want to take the benefit of what you've developed and keep it. All right, so in those circumstances, it's likely that the property you've developed has, in part or full, some commercial aspect to it. It's got some sort of office space or maybe industrial space, and you're looking for a commercial tenant. See, that's when the lawyers come involved with commercial leases. And commercial leases are normally at least 3 years, but if they're 3 years, they'll often have a series of options that might extend it well beyond that. As a commercial investor, or as a developer selling to a commercial investor, ideally you want to ensure that there is a continuing flow of cash coming in for that development. And the best way to secure that cash is to have good tenants committed to long-term leases, paying a good rate of return or a good rental. That will give the investor security to know that the property investment is a secure one. So the lease, the commercial lease, and the duration of that lease and the quality of the tenant are all vitally important factors. Sometimes tenants are aware of this, and if a tenant is very strong and knows it, and the tenant is willing to commit to a long-term lease, talking 10 or 20 years perhaps, they may say, all right, we're a really good tenant and we're looking for a really long lease, so we want the rate, the tenancy rate, to be reduced accordingly. As a property developer, you've got to be careful not to go too far, because the value, the capital value of your investment or your property, in many ways is linked to the rate of return available to you through the rental rates. So you've got to have a good understanding of leasing rates, you've got to have a good understanding of lease incentives, because sometimes you might have to pay for the fit out or accept a situation where there is for a number of months rent free to get the tenant in. But you also need to couple the income coming in with the expected rate of return to a property investor for commercial or industrial property, and make sure that the rate of return that you receive is still sufficient to warrant a reasonable rate of return, which then in turn will provide, through capitalisation, a reasonable value to your completed investment. I hope that makes sense. So when it comes to property investors, they'll be looking for high-grade real estate. You may be looking at a joint venture partner, perhaps with a landowner who has the land, which is valuable, but no cash or expertise to develop it. And you might say, well, let's set up a joint venture company. And as the property developer, I'll provide the development, I'll provide the expertise if you provide the real estate, that type of thing. You can always still go and obtain finance through the joint venture company if need be. Look, another, and this will be the final thing that I discuss, a really interesting way of property development is through forward funding arrangements with an institution. What I mean by this is that forward funding allows for a superannuation fund or an insurance company, for example, to provide short-term funding, development finance, to you as the property developer, but on the basis that it will then purchase the completed product as an investment. I was talking about developing good quality commercial or industrial property so that you can attract good tenants paying a good rate of return. Well, the pension fund, the insurance fund, or the super fund might say, well, that's the type of investment we want. So we're going to get in at the ground level, so we get a say in this, and we'll even provide funding for it, which will provide a rate of return in order to get what we want. Now, as a property developer, be prepared to be proactive in sourcing that proposal, putting it together, because the superannuation fund is not likely to go out looking for land, dealing with architects, engineers, town planners, coming up with concept plans and working out the cash flow projections. But if you as the property developer do all of that and go to the institution with a forward funding proposal, then they may well listen to you. And the overall effect might be that you not only secure development finance, but you also secure a buyer for the overall product. Now, there's a few different ways to calculate how to do this. One of those relates to the base rent arrangements, or another relates to the priority yield arrangement. So have a look at examples 4.1 and 4.2 in your text. You'll see that there are a couple of assumptions made by the authors. They've assumed an agreed base rental of £1.261971 million per annum. There's an achieved actual rental of £1,350,000 per annum. And in the first example, the developer obtains the benefit of one half of this overreach. You'll see that the parties have agreed on a yield of 8.25%. That leads to a capitalisation rate of 12.12. I'll explain that in a sec. So when you look at 4.1, you might get lost in the figures. So I'm just going to mention a couple of things that might make it a bit easier for you. The first is this: the overage figure represents the actual rental achieved above the agreed rent, a base rent. So that's the £1,350,000 more than that other figure that I mentioned. So that's what we call the overage figure. I mentioned the capitalisation rate of 12.12. No real magic in this. They've decided that the appropriate return dividend yield is, or the investment yield is 8.25%. So you work out the capitalisation rate by this formula. 100 divided by 8.25 equals 12.12. So that's your cap rate. Now the gross development value is calculated by multiplying £1,305,986 by 12.12. That's that capitalisation rate. And the developer's profit is determined by deducting £12,765,006 from £15,393,259. I hope that makes sense. It's interesting, UK publication, we're back talking about pounds. It's like the good old days. Now, example 4.2, a couple of things to consider when in trying to understand that. The figure for the development cost is £12,765,006. That's the base figure from which ultimately the developer's profit is calculated. The figure of £989,288 represents what we call the priority yield to the institution. The figure of £63,825 represents the second to priority yield, which goes to the property developer. So when we're looking at the developer's share of rental achieved, this is how we do it. We take the £1,350,000, we deduct £989,288, we further deduct the £63,825, we come to a subtotal of £296,888. If we divide that by 2, we come to a figure of £148,444. And then what we do is we add back the property developer's second to priority yield, which is £63,825. So we get a figure of £212,269. And the developer's profit is calculated by taking that figure, $212,269, multiplying it by the cap rate of 12.12, and it comes up with a figure of £2,572,695. I hope that makes sense. All right, so thank you for listening. Thank you for your patience. You may need to listen to the last part of this lecture a few times in order to better understand the machinations of examples 4.1 and 4.2. As always, please work your way through the tutorial and review problems and try to create some answers to those. I've given you some idea of how long I think you should expect as a minimum to spend on answering those questions. All right, thank you for attending. All the best, and we will see you for later lectures during this unit.